What if you could own one asset that pays you three completely different ways at the exact same time? That's the power of multifamily real estate. Most people think real estate is only about rent checks, but multifamily investors know something different. They know that each building, whether it's 6 units or 600 units, can generate layered, predictable income streams that build wealth month to month. Here are 3 ways multifamily investors really get paid, and why this strategy continues to attract investors from every background. Before we jump in, make sure to like, subscribe, and share. I appreciate everyone watching this video. We're trying to get this channel monetized and basically help as many people we can with real estate investing. Multifamily real estate is one of the most fundamentally democratic wealth building tools available. You don't need to be wealthy to start. You don't need insider access. You don't need to understand complicated financial engineering. You only need to understand how this asset class actually makes money and why it delivers durable returns in almost every economic cycle. Let's begin with the income stream every investor sees first: cash flow. What cash flow really means is the money left over after every expense is paid. In multifamily, that means rent collected, fewer vacancies, stabilized occupancy, and lower risk compared to single family. The beauty here is diversification under one roof. If one tenant moves out, you still have many others paying rent. The income doesn't stop, it simply adjusts. Next, we're going to go over how cash flow is calculated. Every investor, no matter the size of the property, looks at the same numbers: gross income, the total rents and fees collected, operating expenses, taxes, insurance, repairs, utilities, staff, management. We got debt service, the mortgage payment when you subtract all expenses, and the loan payment from income. The dollars left over are your net cash flow. Cash flow is the lifeblood of your property. It keeps operations moving, funds reserves, strengthens the property's financial health, and distributes consistent payments to investors. For long-term investors, steady cash flow delivers financial stability, even during market downturns. Let's take a look at a quick example here. Let's say you own 20 unit buildings where each apartment rents for $1,200. The gross monthly income, say $24,000, operating expenses is $10,000, and your mortgage payment's $8,000. Your cash flow would be $6,000 per month. That's $72,000 per year in income before appreciation or principal paydown are even considered. Unlike single-family properties, multifamily economic performance is more predictable. Vacancy is one unit doesn't eliminate your entire income stream. Tenants collectively support property operations, creating smoother, more stable returns. And that's just the first income stream. The second one's often overlooked, but it's incredibly powerful: principal paydown. Every mortgage payment is partly interest and partly principal. The principal portion reduces the loan balance month after month, year after year. Here's the key. The tenants are paying this for you. Now, why does that matter? Principal paydown is what investors call forced equity growth. You don't rely on the market. You don't rely on the comparables. You don't rely on speculation. You simply operate the property, maintain occupancy, and let time create equity. You're letting the compound effect work for you. Early in the loan, interest makes up for most of the payment. But as the years pass, more and more of each payment goes toward principal. So your equity accelerates. This snowball effect builds wealth whether the market climbs, stays flat, or even dips temporarily. Imagine you purchase an apartment building with a $3 million loan. After 10 years of normal amortization, you may have paid the balance down to around $2.2 million. That means tenants have helped you build $800,000 in equity, even without changes to the property or raising rents. Commercial loans often come with longer amortization periods, lower interest rates, optional interest, only periods boost cash flow early on, while amortization periods later build equity. You can benefit at both stages. Let me say that again. Optional interest, only periods interest. Only periods boost cash flow early on, while the amortization period later builds equity. You can benefit at both stages. The second income stream is predictable, steady, and directly tied to time. But the third income stream, that's where the real wealth creation happens. Appreciation and equity growth. Multifamily properties appreciate in two distinct ways. First, it's market appreciation. Market appreciation happens when macroeconomic factors push property values higher. Consider population growth, job expansion, increased demand for rentals, rising rents, limited supply. These forces lift values naturally without any actions from the owner. The second type of appreciation is where multifamily becomes a true investment engine. Forced appreciation. Forced appreciation occurs when investors increase a property's net operating income, the NOI. The NOI equals revenue minus operating expenses. Multifamily buildings are valued based on NOI, not comparable home sales, meaning improvements to income directly increase the property's market value. How investors force appreciation? They do this by renovating units to justify higher returns or higher rents, improving occupancy, adding amenities, creating new revenue streams through parking fees, laundry machines, storage units, and improving property management. Every dollar in added NOI contributes to long-term equity. Let's say you raise NOI by $24,000 a year at a cap rate of 6%. The property's value is set to increase by you would do that by 24,000 divided by 0.06, which would equal 400,000. That means a relatively small operational improvement can produce nearly $500,000 in new value. This is why multifamily is such a strong wealth building asset. A few ways investors realize appreciation. First, refinancing. Pulling out tax advantage equity while keeping the asset. Second, selling. Capturing all accumulated value at once. Both scenarios convert appreciation into usable capital for future investments. When you combine appreciation with cash flow and principal paydown, multifamily becomes one of the most dynamic financial engines available to everyday investors. So we'll go over that one more time. Multifamily investors get paid in 3 ways: cash flow, principal paydown, and appreciation. If you found this video helpful, please hit the like and subscribe, and we will make another real estate investing video next week. Hope everyone has a amazing weekend, and if you have any questions or comments, go ahead and ask them in the comments below, and we'll be more than happy to answer.